What is behavioral finance? This topic was actually introduced in the mid of the 20th century, but since the last few years, this topic area has been widely researched across globe. So we can see what is behavioral finance in detail. So in the year 2017, Richard Thaler was awarded the Nobel Prize in Economics for his contributions to behavioral economics. Since then, this behavioral finance got widely researched across the globe, and his contributions have built a bridge between the economic and psychological analysis of individual decisions making. Usually, in terms of decision making in stock market and all, this theory is being this area is being widely used. So, what is behavioral finance? It is a subfield of finance that explores how psychological and emotional factors influence financial decisions and market outcomes. This, when we link this behavioral finance, it is usually linked to heuristics or cognitive thinking and all. Unlike traditional finance theory, means in traditional finance theory, it is assumed that investors are always rational. They take decisions rationally. When they hear a news and all, after hearing the news, they will take decisions rationally only and based on complete and unbiased information. But in opposite to that, behavioral finance says that every time people may not take rational decisions. Sometimes they take irrational decisions also and are influenced by cognitive bias or heuristics, emotions, and social factors. So, which are the dimensions or key concepts related to behavioral finance? We'll be just looking into these concepts only, not in detail, but in general. One is prospect theory. Prospect theory was developed by Daniel Kahneman and Amos Tversky. Sky suggested that individuals tend to evaluate potential gains and losses differently. That means if a person is having a perception regarding gain and loss, maybe rupees 50 gain and 50 rupees loss, they will be perceiving this gain and loss differently only. Investors are often risk averse when it comes to gain and risk seeking when it comes to loss. So when it comes to gain, they prefer certainty, and when it comes to loss, they prefer uncertainty. What is the next concept is loss aversion. What does loss aversion means? People or investors will be interested to avoid losses more than individual gain. That is, loss aversion is the idea that people feel the pain of loss more strongly than the pleasure of equivalent gain. Suppose I get 1,000 rupees and I lose 1,000 rupees. In that case, the happiness which I get in gaining 1,000 rupees will be less when compared to the sadness I may incur when losing the same rupees 1,000. This bias can lead individuals to hold losing investments longer than they should in the hope of avoiding a perceived loss. And the next terminology is overconfidence. Overconfidence is a bias. That is, some people, they overestimate or they have pride in their own abilities and the accuracy of their judgment. But in financial context, that is from investors' point of view, from decision-making point of view, overconfidence may not be supporting you all the time. This can result in excessive trading. That means if one person is overconfident, he may invest more and more money in the stock market or other markets. He may invest in one security itself. That is lower diversification. Diversification means investing in different categories of securities than concentrating on one. When we have confidence, we will be investing every amount of money in one particular security and it leads to poor decision making. The next concept is anchoring. Anchoring means some people will be relying too heavily on the first piece of information while making decision. That is, subsequent information may be there, but they will not rely on that heavily. Next is confirmation bias. Confirmation bias means it is an inclination to seek out and interpret information in such a way that they confirm pre-existing beliefs. That is, a person may have some pre-conscious or pre-existing beliefs in the mind, and that will be confirming, and this is actually a bias only. So investors may disregard information that contradicts their investment decisions, leading to suboptimal choices. Next is herd behavior. Herd behavior occurs when individuals follow the actions of the majority. Means majority will be heard, minority may not be heard. That is, in some cases and all, people tend to move with the majority. So that is also a area in behavioral finance. They often be driven by fear or the desire to conform. That means we say that many people say yes, or some people only say no. So majority will go towards the yes. This can result in market bubbles and crashes, as well as irrational investment decisions. Next area in behavioral finance is mental accounting. Mental accounting means categorizing money into separate mental accounts based on its source or purpose. This can lead to suboptimal financial decisions as money is not treated as fungible or replaceable. So that is mental accounting. The next area is behavioral bias in portfolio construction. Portfolio means what? That is all securities or all kinds of securities a person has. Portfolio means diversifying. It is a measure of diversifying the risk. So what is behavioral bias in portfolio construction? Behavioral bias can impact portfolio construction. Sometimes investors may be overconfident in their stock picking ability, leading to a lack of diversification. This is similar to the point which we discussed earlier. That is, sometimes portfolio means there are 5 categories of securities. Maybe one will be equity, one will be debt financing, sometimes in real estate, or sometimes in gold, or different types of opportunities are there. And combining these opportunities together in investment is portfolio. Sometimes behavioral bias will be happening here. And in that case, they may sometimes be overconfident also. In that case, they may also avoid selling, losing investments due to loss aversion. So problems can happen in this particular type of behavior. Next is adaptive market hypothesis, or it is known as AMH theory. It is proposed by Andrew Lowe, which suggests that financial markets are complex adaptive system. Adaptive market hypothesis combines elements of traditional efficient market theory with insights from behavioral finance, suggesting that market participants adapt their strategies based on market conditions and their own bias. So, initially a theory was there, that is efficient market theory. Efficient market theory says that market is highly efficient. That means today, maybe election is there and the election news are coming out, for example. And maybe a particular political party will be winning an election. So that may be preferred for some investors. In that case, there is a trend that the stock market prices will shoot up and the Sensex will be shooting up. So maybe in a particular day, the news which is available in the market may be of a negative news. Then that also will reflect the market. That means stock market prices will be coming down. So investors will be interested to sell the securities. So efficient market means whatever happens in the market, the news that will be implying or it will be reflecting the market. So adaptive market hypothesis includes this traditional efficient market theory plus behavioral finance. That means market will reflect the news, plus they will be adapting their own strategies based on their own bias. Thank you.